Net present value, NPV, is the gold standard for evaluating the financial impact of business and legal decisions. It quantifies whether an investment, transaction, or settlement will create or destroy value by discounting all future cash flows to their present value. A positive NPV signals a value-adding opportunity, while a negative NPV warns of potential loss. What is NPV? Net present value, NPV, is a financial metric that measures the difference between the present value of all expected future cash inflows and outflows associated with a project, investment, or transaction. By discounting future cash flows to today's value, NPV accounts for the time value of money and risk, providing a clear, quantitative basis for decision-making in both business and legal contexts. Net present value, NPV, helps you figure out if an investment or project is truly worth it by comparing all the money you expect to receive in the future with all the money you'll need to spend. But with a twist, it adjusts everything to today's value. This is important because money you get in the future isn't worth as much as money you have now, due to things like inflation and risk. To calculate NPV, you add up all the money you expect to get and spend over time. But first, you discount future amounts to reflect what they're worth today. If the final number, NPV, is positive, the investment is likely a good idea. If it's negative, it might not be worth it. In short, NPV is a way to see if a project will add value or cost you money, taking into account that $1 today is more valuable than $1 tomorrow. To calculate NPV, forecast all future cash flows, choose a discount rate reflecting risk, discount each cash flow to present value, sum them, and subtract the initial investment. For example, investing $100,000 with $30,000 annual inflows for 5 years at a 10% discount rate gives the NPV, showing if the investment adds value. Interpreting NPV results. A positive NPV means the project is expected to generate wealth and should generally be pursued. A negative NPV indicates the project will erode value and should be avoided. NPV in legal and business decision-making. Net present value, NPV, is a crucial tool in legal and business decision-making. In M&A, NPV helps value target companies, assess synergies, and justify purchase prices, ensuring deals create shareholder value after accounting for integration risks. In real estate, NPV evaluates investments by discounting projected net operating income, signaling whether a property is a sound investment. For litigation settlements, NPV quantifies damages and values future payouts, aiding in fair compensation structures. In strategic planning, NPV guides project selection and risk assessment, recommending only value-adding opportunities. This ensures decisions align with client or shareholder interests and reflect both financial and legal realities. Best practices for legal professionals. Legal professionals should contextualize NPV using real-world cases to highlight its impact on settlements and damages. Breaking down calculations step by step helps build clear understanding, while emphasizing the time value of money connects directly to legal outcomes. Incorporating interactive learning, such as hypotheticals and relevant exercises, engages learners and bridges NPV concepts to legal reasoning, demonstrating how financial analysis supports negotiation and effective advocacy. NPV is the ultimate decision tool for legal and business professionals, providing a rigorous, quantitative framework for evaluating investments, transactions, and settlements. By focusing on value creation and risk, NPV empowers lawyers and business leaders to make informed, strategic decisions that align with financial and client objectives. For practical NPV examples in legal practice, see business law publications and case studies.